Good day, students. It's my pleasure to have you again. How has been your weekend? Today we want to have our online class and the subject is agricultural science. The topic we are going to be considering this time is source documents and journals. Source documents and journal. Source document refers to a document that facilitates buying and selling of goods and services. Document that facilitates, that is, the hands buying and selling of goods and services. So what are the type of source of document? Number one, we have the invoice. This invoice is a document used in business transaction. It gives a complete or comprehensive summary of transactions involving sales or purchases of goods. Invoice is written record of goods sold or services provided and the amount charged for them, sent to a customer or company as a request for payment. This document which a seller of a product gives out whenever he sells goods to a customer. It is sent by the seller to the buyer to provide him with following information. Number one, name and address of supplier. One thing I want you to know concerning this invoice is that it's an information that is prepared by seller of the goods sent to a buyer of that particular product. When a particular buyer has made an order concerning a particular goods, so the producer or the seller of that goods will send an invoice to that buyer, and that invoice will contain the goods, the name and address of the supplier, that is someone who owns the business or the producer. Then it also contain the description of the goods bought, okay, and the quantity, the name of the goods, the quantity also be included in the invoice. Then the terms of payment, okay, the terms of payment will also be included, mode of transport, then the discount. There can be a particular discount. For instance, this is a new year. There may be an information in the particular organization that says that whoever that come around to buy goods in the month of January will be giving 20% discount. So whoever that come around to buy these goods in January, the 20% discount will be directed. Let's say, for instance, the total goods the buyer want to buy is around 10,000 naira. So at the time, let's say it's around 725,000 naira. If you deduct the 20% discount from there, what is left is 580,000 naira. So the number of discount, the quantity of the discounts to be given will also be included in the invoice that will be sent to this buyer. The next one is this date of sale. The dates, the sales of those things that take place or took place must also be included in the invoice. Then the amount expected to pay by the buyer after the discount, after you might have removed the discounts from it. So the amount you expect to pay will be given to the buyer. So let's take for instance, in the notebook as an example of invoice. Given you see your note, you have invoice by Kelly Enterprise, Abuja, sold to Ige Ventures, Ikeja. You see the catalog ref. The catalog reference here shows the number. We have there 112. Under the quantity, 25. So let's say, for instance, this organization is selling nails. Okay, nails, for roofing buildings. So someone has come to buy a particular product from this organization. Is buying 20, he bought 25 quantity, okay, of what? Of 14 inches nail. There are different type of nails. Okay, we have 9 inches, more than that. So this person has come around to buy 14 inches nail. Okay, and the unit price, that the price, that's the price for one, is around 5,000. Okay, 5,000 per one. So if you multiply that 5,000 by the quantity, 5 times 25 is going to give you 125,000. That is why we have 125 in the total there. Then the catalog reference to the second product is a 113. The quantity bought is 100, then 21 inches. Then if you multiply the 6,000 in the unit price times the 100, you have a 600,000. So the total the total the buyer is expected to pay is 725,000. But this company is giving out 20% discounts. So if you calculate 20% discount of 725,000, that is 145,000. That is 20%. That is, this 145,000 will be deducted from the 725,000, which is expected to be paid by the buyer. So by the time you deduct that, what is left is what? 580,000. So this 580,000 is the money expected to be paid, okay, by a buyer. So these are the set of information that we sent through an invoice to the potential buyer of a goods, so that if you know the actual money to pay to the producer or the seller of a product. Then another one is a debit note. This debit note is a document sent by the seller to the buyer to correct an undercharged amount of or payment. It is sent to the customer to increase the amount charged on the invoice, thereby increasing the customer debt. Let's say, for instance, now, like I said the other time, an invoice has been sent to a customer who have ordered for a good, all right? But after the invoice has been sent, the seller now realizes that the amount to be paid uh, by the buyer is not the actual amount sent to him or her. So if he or she, that is the buyer, realizes that a particular product has been undercharged, the meaning of the undercharge is that, let's say, for instance, this 40 inches, the actual price is 6,000. Okay, and in the invoice sent to this buyer, what we have there is 5,000. So a debit note can also be sent again, telling the buyer that the money to pay or has increased. Okay, that means the buyer is not giving the actual amount concerning a particular product or items. So the debit note will be sent to the buyer to notify the buyer that he or she has money, extra money to pay on any items which has been undercharged. So that is the meaning of that. Let me use another scenario. Let's say, for instance, now, as a student, you order for a textbook, maybe a agricultural textbook from many organizations, and the actual price of that textbook is 10,000 naira. Okay, but by the time an invoice is sent to you, the invoice says 8,000 naira. Okay, from the invoice you have 8,000 naira. So after the invoice has been sent to you, the producer or the seller now realizes that the money is 10,000 naira. So debit note of 2,000 naira will now be sent to you, telling you that the money of that price has increased, that you are no more to pay 8,000 but 10,000. So that is the simple explanation of a debit note. Debit note is sent to a buyer to notify him or her concerning goods which have been undercharged. Then debit note contain the following items: the name and address of the buyer. Okay, the name and address of the buyer must be there. Date of collection, the date the collection is to be made, also reflects in the debit note sent. Then the amount undercharged. Okay, like I said the other time, I make use of textbook, which is a 2,000 naira out of the 10,000. So about 8,000 will be charged in the invoice. So the remaining 2,000 can also will also reflect in the debit note. So the amount you expect to pay, okay, the amount that is undercharged will also reflect in the invoice note. Okay, then the signature of the cashier or accountant, somebody who's in charge, somebody who detects that the customer has been undercharged, his signature will also reflect in it. Then we have the next one, to number 3, we have the credit note. Credit note. This is the opposite of debit note, and it is used to correct an overcharge account or overcharge payment. Okay, it arises due to some goods which have been charged in invoice but returned due to some reasons. It is sent to the customer for reduction in the amount owned by him. Okay, this credit note is the direct opposite of debit note. Okay, now don't forget I told you the debit note that is sent to the buyer to notify him or her concerning a particular items which shall be undercharged. But in this credit note, it is a note sent, information sent to the supplier, to the buyer, notify him of a particular product which shall be overcharged. Okay, like I said at that time, I use textbook. Being a student for easy understanding and comprehension, I use textbook as an instance. Let's use it again that textbook, the Agric textbook that is 10,000 naira. By the time you approach a particular organization or seller, maybe a bookshop, to buy, okay, and you are sent an invoice of 15,000 naira instead of 10,000 naira. So after the invoice of 15,000 naira be sent to you, so the seller now realize that, oh, that textbook is 10,000 naira, not 15,000 naira. So a credit note will also be sent to you, okay, telling you that that textbook has been overcharged, that the actual price is what is 10,000 and not 15,000 naira. That means you have to pay 10,000 and not 15,000 naira. So that is typical example of a credit note. It is sent to a customer for reduction, okay, in the amount owed by him. So it is sent to you to let you know that the money you have to pay is not up to so amount, that this is the actual amount you are expected to pay. So that is the credit note. Then we have number 4, that they have the receipt. The receipt is a document which acknowledges that payment has been made by the buyer of goods for goods and services. Okay, a receipt is a document which acknowledges that payment has been made by buyer of goods and service. This receipt is a common knowledge. If you buy any goods, maybe in a bookshop, okay, even you as a student, when you pay your school fee, you'll be given a receipt to show that, and to show that you payment has been made by you. So this receipt is an evidence of payment. It's a legal document to show that you have really made a payment for one service or the other that have been rendered. So it is used by the seller to the it is issued by the seller to the buyer to show that he has settled the account. Okay, it is a vital document in business transaction because it can be used as an evidence of payment in the court of law. Okay, like I said the other time, that this receipt is what is an evidence of payment. Anywhere you made a payment concerning a product, a receipt will be issued to you to show that truly you have made payment concerning one item of the other. So number 5, there is you have check. Check is an order written by the drawer to a bank to pay on demand a specified sum of money. Okay, I come again. I say check is an order written by the drawer to a bank to pay on demand a specific sum of money to the person name on it. So check is given by someone to another person. Okay, the person that handles the check, the name will be on it, and the amount to be withdrawn to be taken to the bank for certain withdrawal of money. So it can also be defined as a bill of exchange, okay, that is payable on demand. It may be open check or cross check, which has two transverse lines. Then let's move to the next one, is journal. Journal can be defined as the daily record into which transactions are entered and classified as a debit and credit before they are posted into ledger. Journal can be defined as a daily record into which transactions are entered, are classified as debit and credit before they are posted into the ledger. A journal is also known as a book of original entry. Okay, this journal is where you record the financial income and outward in any organization before you transfer them to a ledger. This ledger is the real account. Okay, and in this journal you can make any necessary correction before you transfer it into the journal. All right. The journal is also known as Book of Original Entry. It can also be defined as a book in which record of all business transactions are written. Every record or items recorded in the journal is referred to as an entry. Please do not forget that and take note of that point. Everything you enter into the journal is known as what? Entry. Now the type of journal. You have a sales journal. This journal is a type of journal used to record the daily sales of business. That is any sales you make in a day. Before you transfer them to a ledger, all right, you put them in a sales journal. Anything you are selling, anything that have sold in a day, you have to be written and documented in a sales journal. Then 2, you have the purchase journal. It is the journal for recording all purchases made in the business. Anything you buy, okay, in one of the business in the day must be clearly spelled out and written, also documented in the purchase journal. You have return inward journal. It is used to record all goods that customer return to the business due to some reason. By the time you sell a particular product to a customer, the customer can return the goods for so many, maybe the the goods get damaged along the way, or maybe it's an expired product. For so many reasons, a particular buyer can return any goods. Okay, so by the time these goods are being returned, you have to record them in the return inward journal. All right. Then the last one there, number 4, return outward journal. It's also to record goods that the business returned to a supplier. Being a supplier or a seller of any product, you also buy the product from the producer. Okay, but eventually you get a particular product from the producer. Now, after you get to your shop, to your business center, you realize that a particular part of the product has been damaged, okay, or they are not in good shape. So you can return them back to the producer. Okay, so the value and the number of those items returned to the producer will also be recorded in the return outward journal. So I want you to take note of the difference between return inward journal and the return outward journal. Return outward journal is what record every item returned by what you sold out, what had been sold out that will be returned to your shop or to your business venture. So you have to record them in the return inward journal. But what you as a person or as a buyer return back to the producer, you record them in the return outward journal because you are taking them out of your business. That's why you call it outward journal. Now, the uses of journal can be used to correction of errors before they are being transferred into the ledger, then opening and closing of entries. All right, opening and closing of entries, you can also use them. Then recording of purchases of fixed assets. Fixed asset, please take note of that. You can correct that in your note if there is a typographical error. Is a fixed is FISED. Recording of purchases of fixed item, fixed assets. Or what are the type of fixed assets? Maybe a land, anything that is not mobile. Okay, you can get that and put them in the sales journal. Then recording of sales of fixed assets. Okay, if you buy any fixed asset, you can put them in the journal too. Then if you sell anything to, you put them in the journal. So that is the end of it. Then you have an assignment attached to the downward page of this note. Number 1 question then, what is the source document? 2, define credit note. Define debit note. 4, what is a journal? Number 5, define sales journal. So these are the 5 questions. Answer the question and put them in your notes. By the time you return to school, I want to see the notes clearly written. Take your time to write the note correctly and answer the question. The assignment to be marked and recorded to be part of your CA. Thank you. Have a nice day.